Continue the market conversation with Wolfe Research's chief investment strategist, Chris Senyek, joins us here at Post 9. Happy Friday, Chris. Good to see you.
Happy Friday. Thanks for having me.
You're encouraged by the highs, I assume, from a technical standpoint?
From a technical standpoint, new highs. The leadership is led by industrials and tech, and those are the stalwarts of the economy. So I think that leadership continues. The earnings results have been very solid. Look at 3M this morning, up guidance, margin expansion greater than expected. Even in the face of tariffs, which they essentially offset by a weaker dollar. So we're very encouraged by earnings season so far.
There a nice chart circulating yesterday on how it's cheaper to hedge tech earnings this quarter than it has been in almost 20 years. What do you think that's telling us about, implied volatility on earnings?
Yeah, I think implied volatility in earnings has been lower than we've seen in a while, right? And the same thing in the currency market, which is one of the most liquid markets around there. And I think what we're seeing is companies are rolling off hedges, and they're not re-hedging because they've lost money on their hedges over the last 6 months. And it's by far the consensus view the dollar probably weakens from here. And so if you're losing money in your hedges, who wants to re-up the hedges right here and get that benefit?
The weak dollar has been very helpful for some of these companies. You mentioned it for 3M. When it comes to guidance, PepsiCo, it looked better than expected. I think Johnson & Johnson cited. Do we need to keep seeing the dollar weaken?
Well, I think that's a risk in the second half, is if for some reason U.S. growth exceeds expectation, and we're quite bullish on U.S. economic growth, I'm more worried about inflation, that the dollar actually strengthens a little bit relative to other currencies, particularly if the Fed doesn't cut in the back half of the year, right? So it's been a tailwind that's benefited earnings of multinational companies. You saw it with Pepsi, you saw it with 3M, you saw it with GE Vernota, you've seen it with a lot of companies, and their hedges are rolling off, and it should continue to help their numbers. But if it turns the other way, the tariff impact could be much more of a sting.
So what do you think about, you said that if the Fed doesn't cut, so you think that the market is too optimistic about Fed cuts?
I don't think the Fed is necessarily cutting in September. And the reason for that is twofold. One is I think the tariff impact has a long and variable lag. We're just seeing the impact of it in this most recent CPI report. I think, frankly, companies don't know how much to raise prices by because they don't know what ultimately the tariff numbers will be. And then secondarily, the growth outlook is really good. And what no one's talking about is we just passed a fiscal stimulus bill, right? The Fed is supposed to incorporate that into their forecast. We can debate what the size of the stimulus will be, but we know over the next 12 months, it could add upward to $250 to $300 billion of stimulus into the economy.
But there's a debate about that. That's not like universally accepted by economists. A lot of economists don't think it's going to add a lot of stimulus because most of it is an extension of what we've already had.
Most of it is, but the incremental, no taxes on tips, no taxes on overtime, expanding the standard deduction, expanding the child tax credit. These are amounts that folks are going to start seeing either through withholdings in Q4 or next tax refund season. So if you're the Fed and you're thinking we're doing our forecast for the next 12 months, you're going to cut rates in the face of what could be an uptick the GDP with sticky inflation.
Can you imagine, though, President Trump is already so angry with the Fed chair for not cutting because of tariffs.
No, not angry.
Right. And then if they say we're not cutting because of the big, beautiful bill, they can't even do that. That's too political.
I can't imagine it, but I think, once we get through earnings season, I think the market consolidates probably 3 to 5%, over the typical seasonality that we have. And we have to get through the impact of the next inflation reports, the next job reports, and what the Fed ultimately does at that September meeting. I don't think there's any chance they're cutting in July.
He wants mortgage rates lower. Mortgage rates bottomed just as the Fed began to cut.
Yeah.
They were 6-1 last fall.
I know. And let's face it, the biggest reason for the cuts at the short end is the government debt situation because there's a lot of paper they have to roll, right? So we all know why they need to cut. But my point is that I think there's risk that they're not cutting in September, and that's what we have to get through from a market's point of view into what is a weaker seasonal period of time as well.
Chris, thanks for coming in.
Yeah, thanks.